Welcome to Accounting Fundamentals Module 3, Constructing a Cash Flow Statement. In this module, we have several objectives. The first one is to explain the format and structure of a cash flow statement. The second is to explain the difference between a cash flow statement and an income statement. And finally, to be able to build a cash flow statement using the income statement and balance sheet in combination. Now, let's get started. As you'll recall from earlier in the course, there are three key financial statements that summarize the financial activities of a business. So far in this course, we've covered the balance sheet and income statement. The balance sheet shows what a company owns, which are its assets, and what it owes, which are its liabilities. The difference between those two is its equity. On the income statement, we see a summary of the revenues, expenses, and resulting profit or loss for a period. Now we can focus on the cash flow statement, which shows the sources and uses of cash for a business. It's divided into three sections: the cash flow from operating activities, the cash flow from investing activities, and the cash flow from financing activities. In theory, it is not necessary to have a cash flow statement, as all cash items could be recorded on the balance sheet directly. However, in practice, that is not practical, and only the closing cash balance is shown on the balance sheet, while all other details are shown on the cash flow statement. Understanding where cash comes from and how it is being used is very important for managers of the business, for financial analysts, and for other users of the financial statements. The cash flow statement organizes cash inflows and outflows into three categories. The first is operating activities. The second one is investing activities. And the third one is financing activities. Let's take a closer look now at cash flow from operating activities. This includes items that are found on the income statement, such as revenue and operating expenses. However, it only includes them if the cash payment actually occurred in that period. So, for example, it just includes revenue that the company has actually received the cash for, and it just includes expenses that the company has paid out the cash for. So, it's similar to the income statement or statement of operations in that it reflects revenues and expenses from the period, but it's different in that it only reflects them if actual cash movements occurred during the period. Now let's take a closer look at the cash flow from investing activities. Investing activities include things like purchasing property, plant, and equipment, or selling those assets, as well as making investments in other businesses, or acquiring or divesting of entire businesses. This is where a company records its capital expenditures as well as M&A activity. If we take the cash flow from operating activities and we add the cash flow relating to investing activities, then we arrive at the net cash flow before financing activities. The final category on the cash flow statement is cash flow related to financing activities. This is very distinctly different from operating and investing activities. This includes things like issuing shares, raising new debt, repurchasing shares or repaying debt, as well as paying dividends. Finally, if we take the cash flow from operating activities, add the cash flow from investing activities, and add the cash flow from financing activities, then we finally arrive at the net cash movement over the period. This is the total change in cash position for the company. Let's explore why profits and cash flow are not the same thing. In Module 1, we learned about prepayments and accrued expenses. The accrual concept requires companies to recognize revenues and costs as the business incurs them, not as it receives or pays the actual cash for them. This is what drives the reporting on the income statement: revenues when they're earned and expenses when they're incurred. Now, let's compare that to what happens on the cash flow statement. The statement of cash flows only records transactions when cash is received or cash is paid. In the coming sections, we're going to look at how this actually works in practice. To illustrate the concept of the matching principle over time, imagine a 5-day transit pass that costs $40 and is paid in cash on a Monday. In this scenario, how much is the cost of daily travel on Thursday? First, answer that question on a cash flow basis, and then answer that question on a matching or accrual basis. When you have answered the question, consider which method better reflects the cost of an individual journey, and which one better helps you plan your personal cash flow. Let's look at the answers now. The daily cost of travel on Thursday on a cash flow basis is 0 because the cash expense was already paid on Monday. However, on a matching principle basis, we take the $40 total cost, divide it by 5 days, and determine that the daily cost of travel is $8. Both of these approaches provide valuable information to the user. The matching principle basis is better for planning the daily cost. However, the cash flow basis is better for planning on actual cash inflows and outflows. Let's do a recap of how property, plant, and equipment, as well as depreciation, work. Let's imagine that ABC Inc. buys a truck for $45,000 in cash. It will use it in the business for 5 years. That is to say, it has a useful life of 5 years. And at the end of that 5 years' time, it has a salvage value of $15,000. Based on those assumptions, the questions we have are, what will the company show on the cash flow statement, the income statement, and the balance sheet in year 1? 2 additional assumptions to make are that 1, the company uses straight-line depreciation, meaning it allocates an equal amount of depreciation to each of the years, and 2, assume that the company charges a full year of depreciation expense in the year that it makes the purchase. Let's look at how these transactions will flow through each of the 3 financial statements. In year 1, ABC Co. would have a cash outflow of $45,000 under investing activities on the cash flow statement. This would be a form of capital expenditure. On the income statement, ABC Co. would have a depreciation expense of $6,000. This is calculated by taking the purchase price of $45,000, deducting the salvage value, and then dividing by the number of years it has a useful life for. Recall we said earlier that the assumption is the company uses the straight-line depreciation method. That means that $6,000 will be expensed each year for 5 years. Now, moving on to the balance sheet, at the end of year 1, the company will have property, plant, and equipment related to the truck of $39,000. We calculate this value by taking the initial purchase price of $45,000 and deducting year 1's depreciation expense of $6,000. So the depreciated value of the asset is $39,000. This value will reduce by $6,000 each year for the 5 years until it reaches its salvage value. Now that we've explained the purpose of the cash flow statement and shown how it differs from the income statement and balance sheet, let's construct one together from scratch. It's important to point out that there are various different depreciation methods that a company can use to calculate depreciation expense. 3 of the most common are the straight-line method, the double declining balance method, and the units of production method. Let's take a look at each of these 3 in more detail. In the straight-line approach, an equal amount of depreciation is applied every year for the asset's useful life. The formula is equal to the cost minus the salvage value divided by the useful life in number of years. As you can see in the graph, an equal amount is expensed every year until it reaches the salvage value. With the double declining balance, it's a form of accelerated depreciation, meaning that the depreciation expense is greater in the first few years and smaller in the later years. The formula for calculating accelerated depreciation using double declining balance is equal to taking 1, dividing it by the number of years that the asset's life is, and then multiplying that by 2 to accelerate it. That number is then multiplied by the beginning period book value of the asset. So this depreciation method requires building an actual schedule and is a much more detailed form of calculating depreciation. It can be useful for a company who wants to lower its tax bill in the early years by having a bigger depreciation expense. The company lowers its taxable income and pays a smaller tax bill. Now let's look at the units of production method. As you can see in this example, the depreciation expense varies each year. That's because the depreciation expense is based on the output that the assets produce. So to calculate it, you take the number of units produced in the period and divide it by the lifetime number of units that remain to be produced by those assets. That will result in a percentage, which is then multiplied by the cost of the asset minus its salvage value. So, as you can see in this chart, there are some early years where not a lot of units were produced. Then in years 5 and 6, production really ramps up, so there's a large depreciation expense. And in later years, it slows down again. This method of depreciation is useful for a company that wants to match the actual output of the business to the depreciation expense that it incurs. Let's begin by looking at the first section of the cash flow statement, which deals with operating cash flows. The most obvious way of showing an operating cash flow would be to record each individual transaction, to show every single inflow of cash and then deduct every single outflow of cash, to have a net result being the total operating cash flow. This method, called the direct approach, is rarely used in practice. The reason being is that it would be impracticable to keep track of every single cash inflow and every single cash outflow in one consolidated financial statement. Now let's look at the indirect method of creating a cash flow statement. This approach takes the net income number from the bottom of the income statement and makes adjustments to it to arrive at cash flow. If the income statement were prepared entirely on a cash basis, no adjustments would be necessary. However, we have to adjust for the following items. If sales were made on credit to customers, there's going to be an accounts receivable balance, and that means cash flow does not match revenue. If purchases were made on credit, there's going to be an accounts payable balance, and that means that expenses do not match cash flow. If inventory was purchased but not sold in the period, that would also make a difference between cost of goods sold and the actual cash flow. There are other income statement items as well that are non-cash expenses. For example, depreciation of property, plant, and equipment, or other items like stock-based compensation for executives or unrealized gains and losses. All of these items need to be adjusted to arrive at the actual change in cash from operating activities for the period. This is the method that virtually all companies use to calculate their cash flow from operations. Now we're going to walk through an example of the typical process for calculating operating cash flow with an indirect method. We begin by taking the net income at the bottom of the income statement and then adding back to it any non-cash items. Depreciation and amortization are the most common examples of non-cash items, but it could be other things that we mentioned earlier, such as stock-based compensation, unrealized gains or losses, or impairment charges, to name a few. Then adjustments are made for changes in working capital. Those changes in working capital include any changes in inventory balance over the period, any change in accounts receivable balance over the period, and finally, any change in accounts payable balance over the period, as well as other working capital accounts. And the total at the bottom after adding up all of these items is the net operating cash flow for the period.